Good morning, everybody. Mike Vacchi here for PrincetonTrader.com with your Thursday morning pre-market webcast. Okay, daily chart of the ES. We're riding that upper Bollinger Band again, as you can see. A couple things to observe here. We have a daily and 3-day pivot zone that's pretty tight, down at 1547.50 to 1547.75. So that's about 7 handles off these highs. What I would be looking for would be a dip today to buy. Simply put, the bears are not generating any follow through, and every day we are seeing that the low of the day is getting gradually higher. You can see that here. The lows of the day gradually higher. Yesterday we tried to get through the 42s. Bears couldn't get it done. The day before we tried to get through the 40s. Couldn't get it done. Before that, it was the 37s. Couldn't get it done. And I've said before, if the bears take days off, the bulls and the dip buyers will get emboldened and they will run it back to highs. Now you're in a situation where we have backed off of the upper band by about 10 handles. So I am not swing short this market. I had a swing short. We did well on it. My stop was down 14.97 back a couple weeks ago, and I got stopped out on the remainder. I'm not back in swing short. I'm being very patient with this entry, and I think that you should be too. And here's why. You have some very tight Bollinger Bands here on the daily. I was telling this to my subscribers the other night. And what you're seeing now is those bands start to expand. Once those bands start to expand, the move can have a lot more duration than you would expect, and certainly a lot more duration than you would want if you're on the wrong end of it. And we're seeing the other side of that in gold. That is some tight bands that are breaking to the downside. So when the bands expand like this, what you see consistently is, with each small pullback, and the 20-day is not involved again, it's starting to look like this. When the 20-day was not involved. And price will continue to reach for that upper band. So I'm looking at 1557 to 1558 as a very short-term level. That for a trade, you could go ahead and take that short. If we pop up to 57.58 today, the market's going to get tired. Okay. Ultimately, though, with respect to swing trades or anything longer term, my eyes really are on the 64 say call it 65 to 68 level. If we do 65 to 68, it's going to punch above. It's going to break through this upper Bollinger Band with a good amount of force. I would be really surprised if we didn't get fairly decent ticks out of there, indicating some exhaustion. We would be more than 60 handles off of my 45-day pivot. Right now, our baseline is only 39 and a quarter handles. That's not a lot. We have tried for the last 2 months to put in an exhaustion top. We are not getting an exhaustion top. It's not working. It's going to take force. It's going to take fear. It's going to take blood. It's going to take all those things. And probably an event, the root cause of which we do not know, in order to really reverse it, because it's got to do two things. It's got to reverse the market, and it's got to reverse it in such a way that the bears can get in, pile on, and stay on. Right now, all that's really happening is you get weak longs that sell. It comes down a little bit, but then the dip buyers come in, and the shorts have been so beat up that they can't hold it, and we just move on to new highs. So only a real exhaustion, or only a real punching, violent kind of a top with something for those bears to hold on to is going to reverse this market in a meaningful way and get us back down into, the ultimate reversion area, which is the 200-day exponential moving average, which we bounced off of on the 24th of January with the fiscal cliff deal. Okay, everybody have a fantastic day. Mike Vacchi for PrincetonTrader.com. I'll be back tomorrow morning with another webcast. Trade them well, everybody.